Okay, so on page 388 in the book, I guess, we're going to take a look at the problem.
It starts on 387.
Starts on 387, okay. Yeah, at the bottom of page 387, this little self-study quiz on McDonald's Corporation. Okay. Wanted to take a look at how you record issuance of stock, basically, right? I think, right? Yeah. Okay, so we're going to compute, look on page 388, we're going to compute the acquisition cost for property, plant, and equipment, and then how did you account for sales tax, transportation costs, and installation costs, and then under the following independent assumptions indicate the effect of the acquisition. Okay, so in part A, paid 30% in cash and the rest by signing a note payable, and then in part B, issued 10 million shares of common stock, 1% par value at a market price of $100 per share, and paid the balance in cash. Okay, good. This is a good one. So back again on 387. In a recent year, McDonald's Corporation purchased, at the bottom, purchased property, plant, and equipment for $2.7 billion. Assume they also paid $216 million in sales tax, $20 million for transportation costs, $12 million for installation, right, and $1 million in maintenance contracts to cover repair of property, plant, and equipment during use. Wow, what do you want to do with all that stuff? First, what are you going to debit with all this? What do you think your debit would be? Making a journal entry for this. We're going to look at what happens to assets, liabilities, and equity, but let's actually call them the accounts, huh? What are you going to debit? It'd be a variety of accounts, but what would they be? At least $2.7 billion. So my cost starts with $2.7 billion. I'd agree with that. Okay, my cost starts with $2.7 billion. Okay, but my question was, what are we going to debit? What are they getting? Yeah, so it'd be, some would go to land, right? Some would go to buildings, probably a variety of buildings, right? And some would go to equipment, property, plant, and equipment. So the total of this is going to be the debit we're looking for, right? So $2.7 billion is what they purchased, but then they paid $216 million for sales tax. How about that? Guess we'll write it as 2,700 million, I guess. The way you could think about it, 2.7 billion, right? That's what that is. Okay, big company. What about the 216 million of sales tax? Is that a cost of buying it? Yeah, yeah. If they don't get to avoid the sales tax, yes, they have to pay it. Okay, so I'd add that. Okay, how about the 20 million for transportation costs for transporting the equipment to me, I assume? Probably not transporting a building or land. That's 20 million more cost, right? If you buy something, you guys have bought things online, right? Sometimes they charge your freight, sometimes they don't. If they charge your freight, do you think you paid more than if they don't charge your freight? Yeah, you think it's part of the purchase price, don't you? Of course it's part of the purchase price, the freight is. Remember I talked about on inventory that sometimes the freight cost to deliver it to you will be more than the inventory cost itself? And the freight is certainly part of the cost of the inventory, right? Okay, so another 20 million there. And then what else did they have? 12 million for installation of the property, plant, and equipment. What do you think? Yeah, that's part of it. Oh man. And then one other one, there's 1 million in maintenance contracts for repairs during use. What's that going to do? Yeah, repair and maintenance expense. That's after we put it in use, right? In fact, how about interest if I'm building something? What about interest during the construction period? I capitalize that, right? The interest on the construction loan becomes part of the cost of the construction. Yeah. How about interest after I start using it? No, that's interest expense. That's an operating expense. Okay, so we actually separate those. Anyway, what does all that total to? 2,916. You guys are no help. 936. 948. 2,948,000,000. Everybody good? So I think I would debit land, buildings, and equipment for 2,948, and then add 3 zeros to it, or 6 zeros to it. Everybody agree? Okay, so then what would you credit? In the first one, what does it say? 30% in cash. So take 30% times that number. Credit cash. How much is that? $2,948 times 0.3. Yeah, 884.4 million. Is that right? Okay, good. Yeah. Yeah, okay. And then credit what? Notes payable probably? For how much? Difference, right? Which would be 70% of the 2,948,000,000. How much is that? Is that right? 2,063,000,000.6. Is that right? They're showing it at the bottom, the solution to self-study quiz on page 388. They show you the entry. They didn't write it properly, but there's the entry, isn't it? Okay? This is how it really looks. Debit, credit, credit. Okay? So that's part A. And then in part B, what do they say? Oh, by the way, how much would you depreciate? Whatever the building and equipment is, I wouldn't depreciate the land, right? It would depend on their lives and all that. So you'd have to classify those as building and equipment. What type of building, what type of equipment. In part B, they issued stock for it instead. So how's that going to go? What are you going to go to with land, building, and equipment, property, plant, and equipment? Right? That means the same thing as that, okay? Property, plant, and equipment. It's still going to be the 2,948,000,000 in there. Okay? This is B. What are you going to credit? What did we give them? Some cash and some stock, right? So some is going to be cash. I don't know how much until I figure out how much the stock is worth. How many shares of stock? 10 million shares. And what I do, I wouldn't do the par value of the stock for the value of the stock. I would do its market value. But I'm going to record the stock at its par. That's what's going to common stock. And anything that is sold for over common stock is what? Additional paid-in capital. Yes, exactly. Okay, so 10 million times what? $100 per share? What's 10 million times $100? Where do we put the decimal? 1 billion? Is that 1 billion? 1 billion. 10 billion? 1 billion, okay. All right. So it's 1 plus 3 zeros, right? It's 1,000 million, right? Which is 1 billion, right? Right. Everybody agree? Just 10 times 100 is the way to go, I think. All right, so 1 billion. So this is 1 billion. Whoops, cash is not 1 billion. Stock is 1 billion, right? But it's going to go to what accounts? Common stock and additional paid-in capital on common stock. So now I know that these two, common stock plus additional paid-in capital, is going to be $1 billion. Everybody agree? But what's the par of this stock? What did they say their par was? 1 cent. Okay? 1 cent. So what's 10 million shares times 1 cent? 0.01. How much is that? It's $100 a share, but that's $99.99 of additional paid-in capital. That's a little review of additional paid-in capital here. What's 10 million times 1 cent? What do you get? Where do you put the decimal, guys? 100,000? Sounds about right. Okay, so my common stock is $100,000. That'd just be 0.1 million, right? Kind of small. Okay. And what's the additional paid-in capital gonna be? 999.9. We get that in the right place, I think? Okay, all right. And then how much is the cash gonna be? That total 1 billion there, right? How much is cash gonna be? 1948.0. Did we do it right? Yeah, they agree with us, they like it. Okay. Everybody good? So what happened to your assets? On this one, what happened to your assets? They went up for by the difference between 2948 and 884.4. So I think my assets went up by 2,064 million, and I think my liabilities went up by exactly the same amount. What do you think happened down here? My assets went up by 1 billion, the difference between those two, right? And my equity went up by 1 billion. That's it. No, that do it? Okay. Good.
I think it was just like the numbers are so big, it's like freaking me out a little
It
bit.
drives you crazy. Yeah, when you start getting that $100,000, which is, 1/10 of 1 billion, yeah. But of course, in real life, you put all the zeros down, and your computer doesn't care. Okay, good. All right, what do you guys want to do today? Just do the quiz? Just do it? Should we do the other present value one first? Well, your minds are kind of on that from the first session we had. Okay. Well, we can start at the beginning. You guys don't care. Just start at the beginning? Okay, yeah, absolutely. All right, first one's on depreciation, isn't it? Okay, so we're doing the quiz for anybody who happens to not be here. Quiz from summer.
I have a quick question.
Uh-huh.
Are you going to go over goodwill, or is goodwill going to be on that quiz?
Oh, it could be, sure. What's goodwill? When one company buys another company, right? It's the only time you can measure goodwill, but goodwill is in most businesses. If you have a business you really like to do business with, I always like to use the example of a restaurant, because most people can relate to that. Do you have a favorite restaurant? Does that restaurant have a different building than other restaurants? Not that much different. Different tables? Not that much. Different plates? Not that much. Even different ingredients going into the food? Probably not that much, right? What do they have? Well, a really good chef, a really good waiters, right? They create an ambiance there. They know how to put the thing together. It's really good food. Well, all that stuff, right? And then all their customers like them. Their employees like to work there, right? They have good relationships maybe with the government. Get the idea? Good relationship with the suppliers, so they always get the best ingredients. On and on, right? What is all of that stuff going to be? Well, that business is worth more than another one that has all the same stuff that doesn't have those relationships. So what would we call that stuff? Goodwill, right? Now, we can't really measure goodwill. If you and I started a business, right? A year later, we could say, oh, we're millionaires because we got $1 million worth of goodwill because our customers like us and our vendors like us and the government likes us. But how could anybody possibly know whether or not it's a real number, including us? We'd just be making it up. And the only time you know about how much goodwill you have is when you sell your business, right? So if I buy a business and I pay more than the fair market value of all the assets of the business that I got, less the fair market value of the liabilities I assumed from the business. In other words, I paid more than the fair market value of the equity of the business, right? What was I buying? Goodwill. It must be all those other things. You can't own your employees, right? You don't own your relationship with your vendors and so on, right? You don't, your reputation, you can't really see it, but it's there. Okay? Everybody good? That's where goodwill comes from. So it'd be the excess. That's what goodwill is. Right? And what do we do with goodwill? We used to actually write it off over time, assuming that it was getting used up over time. But does it go away? Not if you do a good job running the business. It gets bigger, it doesn't get smaller. So what we do now is we value it. Actuaries determine an estimate of how much goodwill is worth each year. And you compare that to what you paid for it. If it declines in value, you have to write it down and you have a loss on goodwill impairment. If it's worth more, you can't write it up, you just leave it where it is. So it's there forever, okay? Goodwill is, right? That's where it comes from. There's been some real interesting cases, lots of them, where people get really excited, one company buying another company, and everybody gets in a frenzy of acquisitions, and what happens if everybody wants to buy a company? Price gets jacked up, right? And people end up paying really far more than the business is worth, and what do you end up with? A whole bunch of goodwill that wasn't real, and then years later they end up writing it off, okay? Yahoo and Time Warner, right, paid way too much for it, that deal. So anyway, an example. Let's try this, did that do it, kind of?
Yeah.
Okay. Let's try this first one. Core company purchased a machine by paying cash of $330,000. I guess they debit machines or equipment and credit cash, didn't they? Okay, it's got an estimated life of 4 years or production of 600,000 units, and an estimated residual of 30,000. And we want to calculate depreciation with straight line. And I'm just asking for expense, but I could ask for journal entries, couldn't I? I could ask for book values. I think I do later, don't I? Okay, anyway, so let's give this a shot. What do I have? Cost, 330,000. Everybody agree with that? And salvage value or residual value is how much? How much are you going to depreciate? 300,000. Okay, so that's my depreciable value. So if I'm using straight line, what am I going to do? Straight line is just going to be what, guys? 300 depreciable values divided by what? 4 years. That's it. And what's that going to be?
75,000.
What's the answer for 2012 through 2015 straight line? 75,000 every single one. What if instead I asked for accumulated depreciation each of those years? Yeah, you'd have 75 the first year, second year, 150, third year, 225, fourth year, 300. What if I asked for the remaining book value each year? Right, it's a little harder, right? What would you have the first year? Let's see, so what we'd do is we'd have accumulated depreciation, and we'd have equipment or machines, whatever it's called. In equipment, how much do we have? Be careful. 330, right? In the first year, we'd put 75 in here. What if I asked for book value? 330 less 75. That's it, right? What would I have the second year? I'd have 150 accumulated depreciation, be 150 away from the 75, or 150 away from the 330. Everybody agree? Yeah, you just keep going. Yeah, then 225 away from the 330, and then at the end of 4 years, where would you be? 330 less 300, you have 30,000, which is of course our salvage value, which is when we wanted to stop, right? Everybody can do this? Straight line's easy. What's the journal entry? If I ask for the journal entry, debit what? Each year, debit what? Depreciation expense, and credit what? Accumulated depreciation, so don't screw that up that I asked for. 2, what is the book value of the machine after 3 years of decline? Oh, wait a minute, we didn't do B. Yeah, let's do the hard part. Okay, on B, if I want to use a declining balance method, am I going to start with the cost or start with the depreciable value? Declining balance method, I'm always taking a percent of what's left. What do I want to do, guys? Use the cost. Otherwise, you'll never get down to the salvage value, the residual value, right? You always have, you're taking a percent of what's left. You'd never get down there, would you? If you started on with the 300. So what I'm going to do is take the book value, year 1, 2, 3, 4. So this is going to be the double declining balance, was it? Or no, it's 150 declining balance, isn't it? 150% declining balance. Okay, this is part B here, right? 150% declining balance. So what I want to do is I want to start with the book value for each year, okay? So what's my book value when I start? It's 330. I got the whole 330,000. Everybody agree? In year 1. And then what I want to do is figure my depreciation expense and my accumulated depreciation, obviously, then. And then that'll give me, when I take my accumulated depreciation away from my original cost, that'll give me my book value, right? My book value is going to be going down every year with depreciation. But how much depreciation expense am I going to have? It's 150% declining balance. What is straight line as a percent, you guys? How many years was it life? 4 years. 1/4 equals 25%. So what's 150% of that? 37.5% each year. Right, guys? 37.5% of what's left. Double declining balance would have been 25% times 2. 150% declining balance is 25% times 1.5. Are we good? It's 37.5% each year of what's left. So what do you do the first year? 330 times 0.375. No kidding. How much is depreciation expense then? Does everybody see where I got 37.5%? 1/4 is 25% a year, right? That's what straight line would have been as a percent, right? And then I take 1.5 times it or whatever method you're using, whatever rate of declining balance. So what's 330 times 0.375? Journal entry. Debit depreciation expense, credit accumulated depreciation. So I got 123,750 now. Okay, so at the beginning of the year I had a book value of 330. What's my book value at the end of the year or beginning of year 2?
6,000.
Yeah, it's 330 less 123,750, right? My original cost, 330 less 123,750. Is that what you did? How much is it?
106,250.
206,250. What are we going to do for the second year? 37.5% of it. Yeah, once you get going, there's nothing to this. Right, guys? Always of the declining balance, I'm taking the percent for that. Right? So 37.5% of 206,250 is how much?
77,342.
206,250 times 0.375. 77,344 sound good? Right in there. Okay. And I'm just rounding it to in dollars. That'll be debit depreciation expense, credit accumulated depreciation, right? So what's accumulated depreciation now? 123,750 plus 77,344. What do I get? 201,094? 84. Oh. Okay, 94. Good. All right. What's my remaining book value? 330 cost, right? That's what's in the equipment account. Less 201,194 is how much?
$128,906. 25 as I rounded.
All right, that's good enough. All right, 128,906. Everybody good? In real life, we use the pennies. Okay. 128,906. When do we want to stop depreciating this? When you hit 30,000. Yeah. Okay. So what's 37.5% of that? 48,340.
Yeah.
Is that what it was? Yeah, it's around. Okay. Debit depreciation expense, credit accumulated depreciation. How much do I have? 249, 434. Okay, guys, that's very good. All right. So what do we have left to depreciate? About 80,000, huh? But we want to stop at 30. I don't know if I made the problem so you actually get there. So 249. Whoops. Sorry. Bad. What's the remaining book value? We just said it. It's going to be 330 less 249, 434 at this point, right? How much is that? I don't think I get down to my 30,000, do I? 0.375. How much is that going to be?
30,212.
I would accept that answer. even though really we do it differently. But 249, 434 plus that now, right? Is my accumulated depreciation. How much is that? Okay, so that's what my answers would be, right? 1, 2, 3, 4. And now what's my remaining book value? 300 less 276, or 330 less 276 is how much?
It's 279.
This is 279. 279, 146? 646?
646.
Okay. What's 330 less 279, 646? It's too much. It's more than my 30,000. 5354. You guys don't need to know this at this point, but really what you'd do is you'd have to switch to straight line at the end. You'd have to take the rest of it. But anyway, yeah.
You sold it, it's worth that much, you sold it when you, as a gain, for 4 years? When you talk about
Yeah, you would. If you sold it for 50,000 and you have a salvage of 30, it'd be a gain. If you've depreciated down to that, right? If I've only depreciated to 50, then I wouldn't have a gain. If I sold it for 50, I'd just break even. I screwed up the problem. I should have either not have a salvage value on the second one or something.
So you want to, so the problem after the depreciation expense, that one, you want to look in the answer?
Yeah, I'd want these four. Okay? The depreciation expenses.
So for A, would they all have been 75,000?
Yep, every single one would be 75. Which makes you real uneasy when you answer it, doesn't it?
Yeah. So
Couldn't have been that easy, but yeah, well,
So you're gonna give us the same problem on this goes Friday?
of course, exactly. No numbers changed or anything. Yeah, good luck. What is the book value of the machine after 3 years with the declining balance method and 150% selling rate? So what's the book value? What did I just ask for there in number 2? Well, it's at the end of 3 years. Yeah, so which one is it? Well, no, at the end of 3. That was beginning. 80,566, right?
Yeah.
Yeah, that's it. Okay? After I depreciated 3 years. Okay? So that'd be that answer. That's pretty easy. What is accumulated depreciation of the machinery after 2 years with straight line depreciation? What would you have there? 2 years? 150. Okay? Just not. Well, if you know what you're doing, it is. All of them are. If the machine was used to produce and sell 160 units in 2014, what would the depreciation expense be under the units of production method? And it looks like that would be really hard, but it's really not. What am I going to do with units of production, you guys? I'm going to take what? The depreciable value of 300, right? Because I want to stop when I get down to the 30. So I'm going to take 300,000. So this is going to be sum of the year's digits. Every method except for the declining balance methods, I always use the depreciable value, not the full cost, right? Because I'm always depreciating it down to nothing. So I'm going to depreciate this whole 300,000 across how many units? Well, 160 this time, but what was the estimate of how much we're going to do in total? 600,000. So how much is each unit going to have for depreciation? 50 cents. How many did I have in this particular year, in 2014? 160,000. Can you guys tell me what 160,000 units would be at 50 cents? 80,000. And all it asked for, that's what? What is that? Depreciation what? Yeah, that's the debit to depreciation expense. And what would the credit be for that? Accumulated depreciation. Just happens to be 80,000 for that particular year. Okay? And it wants to know what the depreciation expense would be. You just tell me 80,000 and you're done. Okay? All right? What is the book value after 1 year using some of the year's digits? And now you're kind of, oh, geez, he didn't really do that, did he? Did I call it? This is units of production. I apologize. Brain's not working good. Units of production. Yeah, anyway, okay. What do we do for some of the year's digits? This is kind of, at this point, it's like, oh, no, we didn't really ask that. Okay.
The answer to 4 would be 80,000.
Mm-hmm. That's the depreciation expense. You agree? Good. Thank you.
Some of the years digits is the same method as years of production.
No, I screwed it up. Units of production is using the units. I apologize. I know, it's awful. Units of production is spreading the cost over the units you're going to produce. So I got 300,000. It's a lot like straight line, only I'm using units instead of time. Yeah, I apologize for calling it the wrong thing. Yeah, I don't know where that came from. Okay, some of the year's digits, though, what do we do with that? For each year, we write down the digits in reverse order. Is that right? Year 1, year 2, year 3, year 4. We happen to have a 4-year life, right? What do? I write down 4, 3, 2, 1. Everybody see it? And then I add them up. What's it going to add to? I think that's the example I did in class even, wasn't it? 10? What if it was a 5-year life?
15.
Do 5, 4, 3, 2. You got it. And it'd be 15. Okay. 6-year life, I guess it'd be 21. Okay. And then what you do is you do 10 tenths over its life. So 4 tenths the first year, 3 tenths the second year, 2 tenths the third year, and 1 tenth the fourth year. That makes sense? And the total is 10 tenths. You better use what? Are you going to use the 300 or the 330? If you use the 330, you'll depreciate 10 tenths of it. That'd be 100% of it. What salvage would you have left then? None. And remember what you want to do here. What do I want? I want to have a salvage value of 30. My cost is 330, so my depreciable value is 300. If I'm taking 10 tenths of it over the 4 years, that's all of it, right? So do you want to use the 10? Do you want to divide 10 into 330 or 10 into 300 to figure out what a tenth is? I think into 300. Don't you suppose? So you stop depreciating when you get down to 30. Otherwise, you depreciate the whole 330. Am I right? Did that work? Did that do it? Okay, well, I probably screwed it up then, too. Okay, never know. So what do? Take this times the depreciable value each case, right? Which is 300,000. Everybody good? So it's 300 each time. So what's 10 tenths of 300,000 over the time? It's 300,000. I'm going to depreciate the whole 300,000, aren't I? I'm doing number 5. Yeah. I want 1 year, so I wouldn't have to do all of them, but I'm showing you how to do it. So what's the first year? 120. So the first year would be debit depreciation expense 120, credit accumulated depreciation 120, and it wants the book value of the machine. What would it be? The equipment cost how much, you guys?
You have 220.
What would it cost, though?
It's 330.
330. Excellent. Okay, thank you. And then what would accumulated depreciation be at the end of the first year? 120, right? You debit depreciation expense for 120, credit accumulated depreciation for 120. Everybody good? So what's the remaining book value at the end of the first year? 210. Okay? How about if I asked for it at the end of 3 years? You'd have to do some more, right? So what would the next one be? Let's go ahead and do it. So 1 tenth is 30, right? So 3 tenths is 90. Everybody good? 2 tenths is 60. 1 tenth is 30. And what are these going to add up to? 300. So I've depreciated the whole thing. In fact, what will be my remaining book value at the end of 4 years? 330 less 300 would be the 30 salvage, wouldn't it? We'd be in good shape, wouldn't it? Okay, so you see why you have to use the 300, not the 330? I hope I didn't do it that way.
I think the class as a whole, we messed up, and then you corrected us. I was already so deep into the problem, we just kind of, we were
sorry.
running out, so I just kind of stopped.
Well, I let you screw up and do it, I guess. So, yeah, what would it be? Every single time, every year when you calculate depreciation, what do you calculate? The debit to depreciation expense, credit accumulated depreciation. Every single one of these would be, right? So what would it be after 3 years? What would you have in accumulated depreciation after 3 years? 120 plus 90 plus 60, am I right? Whoops, that's after 3. Yeah, that's right. So how much is that? That's 270, right? What would be my remaining book value? 60, right? 330 less 270. So you could do it at the end.
Would say the same except if they're going to do it for the years, you just increase your accumulated depreciation.
Yeah. It's always this. Let's do the entries, guys. How does it work? You debit depreciation expense and you credit accumulated depreciation each year, don't you? So let's do it with the sum of the year's digits. That's fine. Okay, so let's do year 1, year 2, okay, year 3, and year 4. And then let's look at what happens in equipment and in accumulated depreciation, okay? And for that matter, let's do depreciation expense. Why not? Let's run through this again. What was the first year? What did we say, 120? Is that what it was? So I started with 330 in equipment, didn't I? And I would debit depreciation expense 120 the first year and credit accumulated depreciation 120, wouldn't I? And what's my remaining book value, we said? 330 less 120 is the 210. Everybody see it? What would you do with depreciation expense at the end of the year? It's an expense account, you guys. What would you do? Close it. That 120 goes away, closing entry, and what do you have left? Nothing in depreciation expense. Everybody agree? But it goes to retained earnings, right? Reduced retained earnings. Then what do we do next year? Debit depreciation expense. Credit accumulated depreciation. What did we calculate it to be for the second year? 90,000. It's 30,000 less each year, right? 1/10 less each year. Okay, that would be debit depreciation expense, wouldn't it? And credit accumulated depreciation. Everybody good? Now what do I have in accumulated depreciation? 210 away from the 330. What would be the remaining book value? 120. Everybody agree? Okay. We'd close this one, wouldn't we? Start a new year. What would you do the next year? Debit depreciation expense. How much did we say it was? 60, huh? Credit accumulated depreciation. Let's look at some things a little solider for you, maybe, guys. We got 60 debit here, 60 credit here. What's my accumulated depreciation now? 270, is that right? 120 plus 90 plus 60. What's my remaining book value, we said? 330 less 270 is 60, right? Then what would you do? I'd close this to retained earnings, wouldn't I? Right? I'm writing it off over its life as depreciation expense. And I keep reducing retained earnings by that amount. Reducing my net income, which will reduce my retained earnings. Okay. And then what do you do the last year? 30,000 more. Okay? With this method, that's what the amounts happen to be. But always we're just calculating how much that entry is. Okay? It's always what we're doing. 30 here, 30 here. Now what do I have in accumulated depreciation? 300. What's my remaining book value? 30, which was my salvage value. Okay? And guess what I do? I close this one too. And I'm done. Okay? Did I have you sell the assets anywhere in here? Yeah, there's one here later. What if I sell this asset for more than 30,000? What do I have? Gain. What if I sell it for less? Loss. That's it. Okay? I was trying to... That was probably worth doing, huh? Look at what the entries are. All right. Ben Corporation sold a piece of equipment. It was a little tough one. For $55,000 cash. Purchased January 1st, 2009 for $200. Had an estimated life of 6 years and 20,000 residual. Good. They're using straight line. As the year ended December 31st. Now this one's tough because they sold it June 30th. Mid-year. What do you have to do if you sell it mid-year? Depreciate it for half a year. Right? What will we have recorded for this thing? If we bought the piece of equipment for 200, so in the equipment account, what do we have? 200, right, guys? Now there could be lots of different pieces of equipment in equipment, but there's 200,000 relating to this one. Okay, so the number's much bigger, but there's 200 related to this one. When I sell it, I'm gonna take it out of there. Would you guys agree with that? What's in accumulated depreciation? Oh, well, how many years have gone by? How much are you gonna depreciate every year anyway? The cost is how much? 200. The salvage value was how much? 20. My depreciable value is how much? 180. My life is how long? I'm using a straight line. Straight line depreciation, 6 years. I made the math easy, didn't I? What's your depreciation expense each year? 30,000. 30,000 per year depreciation expense. Everybody agree? You would debit depreciation expense and credit accumulated depreciation every year for 30,000, wouldn't you? And after I've done it 6 times, I'll have 180 in there. Well, how long have I had this asset? Let's see. I bought it January of 2009. So at the end of 2009, I'm going to put 30,000 in here. Everybody agree with that? Okay. Guess I should show the zeros if I have them up here. Okay. So my remaining book value would be 170 at that point, right, guys? 200 less 30. And then 2010, I'm not selling it until when? 2013. 2010 would be another 30. Everybody agree? So it's now 60. 2011, another 30. It's now 90. We're going good, huh? 2012. I'd have another 30. All you needed to know, there's 120 in there, huh? Right? You didn't have to write the entries or anything. Okay, so you got 120 in there. What's the remaining book value at that point? 80. But then another half year goes by. 1/2 of 2013, right? How much do you need to add to it? 15. And you know what? That's what made this problem hard. That hasn't been recorded yet. Because you would have made the journal entry at the end of December last year, right? For your appreciation, but you wouldn't have made an entry on this since then. They're only doing annual statements. So what do I need for that 15? Credit accumulated depreciation for 15 and debit depreciation expense. That's what made this one hard. You've got to depreciate it up to the point that you get rid of it. Okay? Kind of makes sense, doesn't it? Because I don't want more gain or loss. I don't want to change gain or loss here, right? More gain or less loss on the deal. I want to record my depreciation expense separate from the gain or loss. Then I'm going to retire it. So how much do I have in accumulated depreciation now, everybody? 120 plus 35 or plus 15 is 135. Is that right? What's my book value? 200 less 135 is 65. And what did I sell it for? So what happened to me? Lost 10. You got it. Okay. So what I want to do is I want to record the cash I received, which is 55,000, is it? I want to get rid of the equipment that I don't have anymore, which was 200,000. I want to get rid of all the accumulated depreciation because I don't have the asset anymore, so I don't want any depreciation on it. And that also would be combined with a whole lot of other depreciation on other assets, right? I'd have millions of dollars of accumulated depreciation. We're just getting rid of the 135. And what else do I need? Loss on sale. You got it. How much? 10,000. Ta-da. Okay? But I'd want all of these. They're probably half a point each or something. Okay? You guys can do it. Let's try number 3. Give the required adjusting journal entry at December 31st, 2012, the end of the annual accounting period for the 2 items below. If no entry, say why. Paul bought a pack. What kind of an asset is this? Yes, right. This is an intangible. And what are you going to do? Amortize it over its life, right? Goodwill's an intangible asset too, but we assume that it's not being used up, right? So we test for impairment. We just talked about that. Okay? So they bought it for $8,000 on January 1st, 2012. It was registered in 2006. It has a 20-year life from registration. Oh, well, wait a minute. We don't get 20 years because we bought it, what, 6 years later? Is that right? So how many years do we get? 14. We'll use the patent for the other 14 years. So you spent $8,000 cost. Amortization is straight line. We didn't cover this in class, but it's pretty simple, isn't it? It's always straight line. And it's got 14 years left. What's 14 into 8,000? The life for me is 14 years.
It's $571.43.
Okay, now what do we do with this? Debit amortization expense or patent amortization expense for $571.43 and credit what? Usually just the patent itself. Some people would do an accumulated amortization account. Don't call it accumulated depreciation though. The author just went straight to patent stuff, but just reduce it directly. Okay? That's really better. Everybody good? It's not bad, is it? Huh? Yeah. Mm-hmm. Poe acquired a gravel pit on January 1st, 2012. It cost 30 grand. The company estimates that 90,000 tons of gravel can be extracted economically. What if they pulled out 10,000 tons and sold it? Well, we're going to spread the 30,000 cost over 90,000 tons. This is going to just be like units of production, only it's not depreciation, is it? Right? It's depletion, we call it, of natural resources. So this one's going to be depletion. Okay? So it's $30,000. And I'm going to spread it over what? 90,000 tons. These are just too simple, ain't they? What's that? 33 1/3 cents per ton. Of course, we have to extract it and haul it and everything else. So yeah, okay, but that's what it's costing for it, for the gravel. Okay, and there's 10,000 tons. So what's 10,000 times that? Tons, tons. How much is that? It's a third of it, or 1/9 of it, isn't it? It's 1/9 of 30,000. 3,333. Okay. What do you want to do? Well, this is an interesting one. I would take debit depletion expense and credit gravel pit. Right? Gravel pit's going away. Using it up. Or it could be accumulated depletion on gravel pit too. Yeah, what might be debit seeing as they sold it? Instead of, I would take this if you did it. Depletion expense. I took it. Some people would actually do that for the 3,333.33, right? For that number, okay? And then credit either the gravel pit itself or accumulated depletion on the gravel pit. Because you might want to keep the gravel pit at its original cost and then show the accumulated depletion. You can do it either way, okay? But you know what? That's probably not really depletion expense this time, because what did they do with it? They sold it, so what do you think it is? Well, it's not revenue, though. I sold it for far more than that. I debit cash and credit revenue for what I sold it for, or debit accounts receivable and credit revenue for what I sold it for, right? Sales. What would it be? No, it's not a gain. This is a cost. But I probably wouldn't call the cost depletion expense. I'd probably call it, cost of what I sold. Yeah, cost of goods sold. It's part of cost of goods sold, isn't it? Right? I sold it. So that'd be fine too. Depletion expense is okay too. Okay? Those aren't bad. Those are more just did you do some of the homework problems? Did you think about the chapter and read it? I hope. Okay. Try something else. That all okay, guys? Not bad. Animal.
What kind of expense was for the government?
Part A, debit amortization expense, or patent amortization expense, and then credit patents. Yeah, going away, okay? Just use straight line on all those things, okay? Saddle Corporation purchases equipment to be used in manufacturing. The purchase was made at the beginning of 2009 by paying cash at 210. So they would have debited equipment and credit cash, is that right? The equipment has an estimated residual of 10, so my depreciable value is 200, right? And useful life is 10 years. 200 divided by 10 years is 20,000. Everybody staying with me? Okay, and then they changed the useful life. Oh, and they changed the residual value. So now what do? We don't go back and correct the previous years. What do? Just change the current year and into the future. How we depreciate it. So let's think about this. I have equipment. How much did I put into equipment, everybody? Debit equipment for how much? 210,000. Credited cash for 210. Right? Everybody's staying with me, right? Let's see what I have in accumulated depreciation at the time that I changed the life. Well, what would I have done? My cost was 210. Everybody good? My salvage value or residual value was 10. My depreciable value was 200. My method of depreciating it is straight line. How many years life? Well, what did they start with? 10 years. Right? So if you divide 10 into 200, what do you get per year of depreciation? 20,000 per year depreciation. Debit depreciation expense, credit accumulated depreciation. All right? Everybody agrees? Okay, so what would I have in this account? Okay, accumulated depreciation if I'm doing debit depreciation expense 20 and credit accumulated depreciation 20. And I did it starting in when? 2009? Beginning of 2009? So I've got 2009, 10, and 11, and it's the beginning of 12, right? Which is the end of 11. So haven't I put 20,000 in here 3 times? You guys agree with that? So I've got 210,000 in equipment, and I've got 60,000 right now in accumulated depreciation. Does everybody agree with that? So what's my book value now on this asset? 150. Okay. So my book value at this point is 150, and that's what I have left to depreciate. Because my salvage value is what now? They changed it to what? They changed the life to 7 years. 0. So I'll subtract nothing from 150, and what's my new depreciable value? 150. Everybody got it? What if they said my salvage was 10? Well, it'd be 140, and whatever it is. That makes sense? So there's no salvage. So I'm going to depreciate 150. How many years am I going to depreciate over? The original life was 10, and now they think what? It should have been what? 7. Oh, it's not 7 left. They didn't change the life into, well, it used up 3. That would have still been 10, right? Okay. So it's 7 total, and they've used up 3. So how many are left? 4 years. So I got a 4-year life, guys. That's all it is. Divide the 4 years in here, and what do you get? 37,500 per year. So what would my entry be? It says the journal entry for 2009. Debit depreciation expense and credit accumulated depreciation. That's what your depreciation entry always is those accounts, right? And how much? We just calculated 37,500. Now think about this. So that's the answer to part A. Right? Oh, wait a minute. They wanted 2009 first. I lied. What was 2009? It was the 20. Yeah. 20,000. And credit accumulated depreciation 20. Read your own question, too. Yeah, so here's 2009, 10, and 11 entry is that one, right? And this is going to be what? Yeah, this is B. This one's A. This one's B. So how many years did I do this? 3 years, right? That got me to 60 in here. How many years am I gonna do this one? 7-year total, 4 years. What'll I have in accumulated depreciation after I do this? 4 more times. I'll add 150 to the 60 one. I'll have 210 in there. It's got no salvage at the end. Everybody good? 60,000 plus 37,500 plus 37,500 plus 37,500 plus 37,500. 4 times that. What do I end up with? Well, 210. Okay. I'm going to add 150 more, right? 37,500 for 4 years. Another 150 added to the 60 that's already there. We got it all. Okay? No salvage left. Can you do that one? Okay. Take a look at 5. Max Corporation purchased a parcel of land for $1.2 million, paid transfer fees of $50, graded the land at a cost of $250. Are the transfer fees part of the cost of the land? Yeah, you got to pay those or you don't get it. Any taxes associated with it, anything that's associated with it is part of the cost of getting it. Real estate fees, whatever. Okay. And then it says they graded the land. Now what does that mean? They leveled it off. So is that a land improvement that's going to go away? Is that like a parking lot or a gravel lot or, gravel road or something? Is that something that's going to get used up over time? Or is it permanent if you level the land? It's permanent, so it becomes part of the land. That makes sense? What if it's temporary? You put a road through it. That'd be land improvement, yeah. And you would depreciate that over its life, right? Okay. Because it'd have a life. The land doesn't have a life. Leveling it off is part of the cost of it. Okay, but then what they did was they paid $210 for a parking lot. That's going to be a land improvement. Make sense? And then $60,000 for security fences and lighting. That's like equipment, isn't it? Right? Okay. So so that's land improvements too. Okay, and then they excavated and poured a foundation for a warehouse that cost $200,000. What's that going to be? Part of the building, not part of the land, huh? They constructed the warehouse for $4.3 million, including $300,000 for design. So you're only going to pick up $4 million for the building, or $4.3 million? I pick up the $4.3 million. You got to pay for the design as part of the building, right? Okay, yeah. Additionally, they incurred $250 for interest costs during the 2-year construction period. How about that one? It's during construction. That's part of the building. How about if we added that they incurred another $100,000 of interest expense after construction was completed on the debt? Now that's operating expense. It would be expense in the period. It wouldn't be part of buildings. So the way I'd approach this is I'd say land, building, and equipment. Here we go. The $1.2 million, where do you want it? Land. Okay? How about the $50,000? Land. Okay? Put that in there. How about grading the land for $250? Put it in here. Okay, part of the land. Parking lot? Oh, it's not equipment, is it? It's land improvements. I apologize. Don't need equipment. Land improvements, which are separate from the building. They'd have their own life. Okay. Land improvements gets how much? $210 for the parking lot. All right. Security fences, probably go in there too. Okay. Seeing as they didn't give me anything else. And lighting. Okay. Over the next 2 years, they poured a foundation for the warehouse for $200,000. Took them a while, didn't it? Okay. And then they constructed the warehouse for $4.3. Okay. Got all those. Okay. So the 300 is already in there, so I'll leave it, right? 4.3. Additionally, incurred $250 for interest costs. That's part of the building too, because it's during the construction period. It's one of the costs incurred to get the construction done. If you bought the building from somebody else, would you have to pay for the foundation? Would you have to pay for the building? all of the materials, labor and overhead that go into the building, all the other costs. Would you have to pay for the interest during the construction period? Any taxes associated with that? Would you have to pay for everything? Yeah, plus their profit. So if you build it yourself, you still get to capitalize it, part of the asset. Okay? Oh, okay. Sorry. Yeah, that'd really screw me up, wouldn't it? So what do you get in total for each of these? 1.5 million here. What's this one? 4.75 million. Okay, and this one is 0.47. Yeah, I'll just say 470,000. Okay, everybody agree? What you got?
270.
Oh, 270. What math skills? Doesn't do any good to try to go faster. Okay, 210 and 60 is 270 still. Yeah, okay, good. Everybody got it? You do something like that? It's just identifying what's part of the building, what's part of the line, what's part of the improvement. You like that? Okay. What, I give 1 point for it or something? Yeah. Then it doesn't take long to do that. What's that?
I would honestly not even read that for 1 point.
Get a brush, just go and
If you're done with everything else, you would,
I
wouldn't you?
know that you,
Isn't this fun? No, but are you really getting somewhere? Yeah, probably, right? So just learn to concentrate and learn to work, and it'll be just fine. And that's a lot of, I told you that before, that's a lot about what one-on-one's about, is just getting you guys to do something. A lot of your classes are that way when you're freshmen. It's just, come on, you guys, come on. Honestly, you read the book, it helps. It's amazing, none of us want to read anything anymore, huh? Everybody says anymore. When I was your age, I didn't want to read anything either. I still don't want to read anything that's technical, hard work. I want to read stuff that's fun, so. But it kind of pays to read things that are technical and hard work, and then you get to know how to do stuff. It's kind of worth it. Kinda. Okay. Let's borrow $400,000, number 6. $400,000 on a 7% 1-year note. It's dated November 1st, 2009, and the annual accounting period ends December 31st. Okay, so it wants the entries. What would the entry be on November 1st, 09? What'd you get? Yeah, debit cash 400,000. Please don't miss stuff like this. Credit what? No, it's payable. You didn't used to know that, you guys. It's remarkable. No, that's good. Okay, you know what a note payable is now. That's it. B. What happens? How much time went by? Be careful. This is November 1st. What's this one? December 31st. How many months is that? 2, not 1. 2! November 1st, all of November and all of December. Real common mistake, right? Be careful. What day is it? Okay? If we just said October 31st, it'd still be 2 months. All right? So be careful. Anyway, so what are we going to have during the year? Time going by. We borrowed money. Time goes by. The cost of the money is called interest. Interest what, if we haven't accrued it? Expense. Okay? Are we paying it right now? No. We are accruing it. So it's interest what? Payable. Excellent. That's it. So it's 400,000. What's our interest rate? Okay, a whole year would be 28,000, but I'm going to take 2/12 of it because 2 months went by. 1/6, whatever. How much interest is that? 4,667 maybe? 66 forever? Okay, right? Everybody good? Okay, it's 1/6 of 28,000 anyway, that's about right. 4,667, and of course you could put the pennies, it'd be more accurate if you did. All right, and then it gets tougher. What's going to happen on October 31st next year? Now, it was a 1-year note, so when is it due, of course? October 31st, right? Or November 1st, whatever. It's due, isn't it? Okay? So I guess we're paying it off. So, what's getting paid off? What goes away? The note, yeah, you don't have the note payable anymore. You guys are getting so you think this way, huh? It's kind of scary. We're turning you into business people. It's awful. Okay, no, that's good. 400,000, make you valuable. Okay, debit notes payable, 400,000, huh? Credit what? Did you pay it with cash? How much cash are you going to give them? This is 400,000 times 7% for a whole year. How much is the interest? 28,000. Yeah, so how much cash are you going to give them? 428. Everybody agree? It's 428,000 cash, isn't it? Okay, now it gets harder. 400 plus the interest, right? 28,000 interest. Everybody sees where the 28 came from? Yeah. What do you want to debit? Assuming I made no reversing interest, you don't even know what those are yet, so that doesn't matter to you. Some of it's interest expense, but I don't think, some of it's interest expense, but I don't think all of it is, do you guys? Well, you already accrued, not paid. You haven't paid any of it yet, but you accrued. What does accrue mean? I recorded the expense even though I haven't paid it yet? Yeah, okay. So I'm going to have interest expense, and how much is the interest expense going to be? Well, how many months did we have? Be from December 31st to October 31st. How many months this year? How many months is that? 10. So what would 10 months interest be? Let's see, 28,000 for a whole year times 10 12. How much is that, you guys?
23,000.
Yeah, look what's happening. This, I would have. Yeah, I'd take the 28,000 less the 4,667 and get the 23,333. But it's 10 months interest, isn't it? Okay? So how much interest expense do I have for this year? Last year was 4,667 in 09 for 2 months. This year is 23,333, right? For in 10. So isn't this 23,333? My journal entry doesn't balance. It doesn't balance by 4,667. Yeah, because I don't have a liability if I paid it. Interest payable's gone. Excellent. And that's it. That one wasn't too easy, was it? 1, 2, 3, 4, 5, 6, 7, 8 entries for that. Okay? That good? It's stuff we've looked at before, though, isn't it? Taking it a little step further. Okay. And number 7, I guess. The following data were provided by the detailed payroll records of Mountain Corporation for the month of March 2011. I guess compensation is the total wages, huh? 35,000. And then taxes were withheld for income taxes. I guess it's probably state and federal both. Okay, states that have state income tax. 7,350. Union dues were withheld to Social Security tax. It's higher rate than that now, 8%. The employee pays that, and so does the employer. Okay. And then there's also Medicare that's paid by both the employer and the employee. Prepare the March 31st, 2011 journal entry to record the payroll and the related employee deductions, and then give the entry to record the employer's Social Security. That's what FICA is, Social Security. Okay. So, what would you do in Part A? What do you want to record? These people work for me, so what do I have? It says it was wages, so what do you want to call it? Yes, excellent. It's wage expense because they work for me and I used up their work. Huh? How much is the wage expense? 35. That's all you got to do. Debit 35,000 wage expense. Okay? And it might be officer salary expense or sales salary expense or whatever. Okay, whatever it is. Okay? Debit. All right? What are we going to do with the withholding? How about calling it federal tax withheld? But it's payable. Who's it payable to? That's $7,350. Who is that payable to? I took it out of my employee's paycheck. I'm not gonna pay them the whole $35,000, even though I do owe them $35,000. On their behalf, I am gonna send that $7,350 to the federal government. Their tax withheld. And I have to do that. If you don't send that money to the federal government says you stole it because you did, right? It doesn't belong to you, it belongs to the employee, right? Payable. Okay, right? It's the employee's money. Why do you suppose the government has us withhold that from their paychecks and send it to the government? Why don't they just give us our full paycheck and trust us to send it in ourselves? Kind of duh, huh? Right? Imagine trying to collect them. Okay, so yeah, so it has to be withheld. You have to send it in. What else did they withhold? There's union dues, right? These union dues are being withheld from an employee's paycheck it's on their behalf. It's payable to the union. We're going to write a check to the union. That's $175. But we withheld something else. What did it say? FICA tax is 7.65%. FICA tax withheld, which is also payable to the federal government. Okay, how much is that going to be? Somebody with the calculator want to take 35,000 times 7.65. How much was it?
$2,677. You get .0765, right?
Yeah, that's exactly right. 0.0765 times it. Okay? All right, that makes sense? So then what's the rest going to be? We're recording it to record the payroll. What would we have? Wages payable. You got it. How much are we going to pay to the employees, in other words? 35,000 less 7,350 less 2,677 less 175. That'd be it. So this is just doing a simple payroll. How much the employees end up with? It is depressing when you look at that. Gosh, earned all that money. Where is it? It's like every time I get an opportunity to do something to earn 4,000 or 5,000, it's going to take some time. And my wife will say, "Well, that'd be really nice to have the money, but you're not going to get 4,000 or 5,000. We're going to get 60% of that." Yeah, I know. Want the money or not? Right?
You don't round it. We got $24,797.50.
Okay, so, well, that was 12, so yeah, 98. Okay, yeah, right. Okay? And you really wouldn't in real life. People want their pennies. Yeah, real money you're sending them. Okay, but well, let's go ahead and do the other one, and then we'll do the payment too. I didn't have you do that, but let's record B. B is the employer's share of the taxes. You know what that's going to be? Tax expense, payroll tax expense. You like it? The payroll is what we're paying them, and even though we're paying some of it to the government, we're paying it on the employee's behalf. It's not our taxes, it's theirs. Payroll tax expense. Sound good? What's the employer's share? What do they have to pay? That FICA tax. And really there'd be a Medicare tax too the employer has to pay, and maybe some state labor and industry taxes and a variety of things. So how much is that? 2,677. Okay? And credit what for 2,677? FICA tax payable. Actually, I'd probably take the withholding out of there. Come on, Key. So I can use the same account. FICA tax payable to the federal government. Something like that. Sound good? All right, so that was the problem. But let's do one more thing. What if I added C? Let's pay these. What would you do when you pay the wages? This is too easy. Credit cash, debit wages payable. Excellent. That's exactly it, guys, for 24,798, right? That's when you wrote the checks to the employees. That's what you do. What would we do when we send money to the union? Debit union dues payable. So if I give you something like this, relax. It's the 175, isn't it? Credit cash, sound good? Everybody staying with me? And then what else would you do? What would you send to the federal government? That one's tougher. The 7,350, the 2,677, the employee's share, and then our share too. What would that look like? Debit, federal tax withheld payable. I was telling you, the federal government thinks you stole this money if you don't send it in. If you ever are running a business and you run short of cash, which everybody does run short of cash when they start businesses, do not borrow your employees' taxes. Don't do that. Don't ever let your partner do that. Don't let anybody you're affiliated with do that. You can go to jail for it. Everybody hear that? It's theft. You're stealing tax dollars from the employee and from the federal government. Oh my gosh, don't be crazy. What you do is you go to the bank and borrow money and pay those taxes, right? You deposit them, all of them. I've had clients do this, and I just, oh, I panic. I don't want to be affiliated with you. And I'm like, what? Geez, you can't keep that money and wait to pay. Oh, we don't have the cash. I don't care. Sell something, right? You're going to jail, okay? So this, you'll see it in the press, by the way, a lot. And some businesses been closed down. The federal government came in and just shut them down and sold off their assets and take stuff. They're giving the money to the employer. They have to give the refunds, right? If people didn't make very much money, they have to send back the refunds and stuff. Also, the government has to finance their activities, of course. Okay, whatever that is. And then FICA, tax payable. How much would that one be? Seeing as I put it in one account. 2677 plus 2677, how much is that? 53. Somebody want to do that for me? 2677 times 2, because there's the employee's share and the employer's. How much? Excellent. And then what would you credit, of course? Cash for the total amount. 12,704. Okay? Everybody good? Because the employer matches it. The employee pays that, is about 8% now, 8.65 I think or something like that. But the employee, this is old, but the employer pays exactly the same amount the employee does, half and half. If you're self-employed, you have to pay double the amount because you have to pay both shares if you're self-employed. So being self-employed is expensive. Yeah, that's right. It's funny too because you don't think about that, you know, when they're working for the employer. You don't think about that 8% that they're putting into your retirement for you, right? I'm not suggesting Social Security Fund has all that money in it. It doesn't, but that's how we're paying out.
That's what that is when they're paying it, Central Social.
Yeah, when you pay Social Security, that's funding Social Security for people who are already retired, really. We borrowed all the money for World War II and for the Korean War and for the Vietnam War. Borrowed it. We took all the money and spent it on fighting wars, pretty much. So the money all got commingled, so there is no Social Security fund. By the way, Social Security bankrupt? No, it's not. There's money, there's enough coming in to pay out. If we raise, I read somewhere that if we raise to 250,000, right now it's about 130,000 or something. The first 130 or so that we make, you have to pay Social Security on. After that, there's none. If we raise to 250, we fund Social Security for the next 50, 60 years. If we raise it to $500,000, we fund it forever. Right? So, you know, it's not bankrupt, we just have to pay more. Okay. With inflation, though, we never raise it. And as it's inflation, and we're paying more out, we have to, of course, raise what we bring in. So, okay. So that's that one. And, yeah. We did 8 in class. You want to do 9? Okay. And we can come back and do 8 again if people want, or whatever you want to do.
9, 10, 11, 12, they're all pretty easy.
I think they are. Yeah. They're not bad. Okay, yeah. And Yeah, I didn't get real carried away here on the present value and future value stuff. I wanted some straightforward ones, and I'll do that with you guys too, pretty much. In the next chapter, we'll do some more complex ones, right? Just by virtue of bond, it's more complex. So, if the market rate of interest is 8%, what do we know, guys? Here on number 9. We know interest is 8%. So, what do we want to look for, by the way? Interest rate, what else? Number of periods, what else? Present value, what it's worth now, or future value, what it's worth out that number of periods, right? Yeah, those are the things. And then there also is a possibility of there being a what? In our case, ordinary annuity payment, right? It could be an annuity due too, but we won't have any of those. Ordinary annuity means it comes at the end of the period, okay? Payments at the end of the period. If the market rate of interest is 8%, a rational person would just as soon receive $1,200 4 years from now. So what's N, guys? 4. And what's the 1,200? I'm receiving it 4 years from now. It's a future value. This is not hard if you just let yourself relax and think about it, huh? Okay? So they want to know what amount with a rational person would just as soon receive what? Well, just take the 8% interest out of it, right? Find out how much would you have to invest now if you were going to earn 8% interest for 4 periods and have 1,200 at the end. That's all we're doing. So what I want to do with this thing is I want to say, all right, my future value 4 years from now is $1,200. Okay? I'd like to know what it's worth now. That's all it's asking me for. Okay? That's what I'm after. So what do? Discount it for 4 years at my 8% interest rate. 1 plus the interest. Oh, I should have written that down here. I'm sorry. Do a little better notation here, too. 1 over 1 plus the interest rate raised to the number of periods, which is 4, huh? 1 over 1.08 is 8%, right? Raised to the 4th. What I'm doing is I'm dividing the 1,200 by 1 plus the interest rate. Dividing the 1,200 by 1.08, and then I take that amount and divide it by 1.08, and then divide that by 1.08, and then one more time, divide by 1.08. Everybody got this? So 1 over is just dividing, isn't it? Okay? You can look up that factor, or you can calculate it directly. What's the factor? If you look at a present value of a sum table on Appendix A, page A1, what do we get for 8% 4 periods? Careful. I'm discounting. So, by the way, do you think this present value is more or less than the future value? Less, because you're adding interest. So this factor has to be what? Less than 1. Will that do it? Keep you on the right table, right? Okay, so I'm looking at page A1, table A1 on page A1. I'm looking at 8%, and I'm going down to 4 periods. What factor do you get? What do you think you'd get if you put in your calculator 1 over 1.08 and raised it to the 4th? Yeah, that's it. Okay? If I invest 73.5 cents right now at 8% interest, compounded annually, what will I have at the end of 4 years? $1. So what's the present value of $1 received 4 periods from now, discounted at 8%? 73.5 cents. Is that working for everybody? Intuitive. It makes sense. That's what it's worth, because that's how much you'd have to invest to have it grow to the dollar, right? But I'm not going to have $1. I'm going to have $1,200 4 years from now. And each of those dollars is worth 73.5 cents. So what do? Take 1,200 times 0.735. So how much is it worth right now? Something like that. Okay, good. We got it? Actually, you left it in the calculator, so you had a better number than the 0.735. Right? So it'd be a little different if you used the table. Yes? 882 is just fine. $882 is right. Yeah. Either up or down, depending on if you're 50 cents up, 49 down. Okay? Or you can just give me the pennies out. All right, everybody good? Yeah.
Okay, so on these, like, you're doing like the division or whatever, when in class, you're doing multiplication, like what's,
No, oh, well, okay. If I want to do a present value, what am I doing? I'm taking the interest out. So that's why it's 1 over. I'm dividing over and over and over, basically, right? If I want to do a future value, in fact, we could take this one. Let's say that I knew the 882.04. I know that value, the present value, but I don't know. Let's say I know this one. This is 882. But I don't know this one. And you had to calculate the future value. How would you do that? Then what you'd say is I have a present value at time 0 of 882. And I would calculate my future value sometime out in the future. This one happens to be time 4, right? What I do with this one is I take it times 1 plus the interest rate. Okay, instead of dividing, I'd be multiplying, raised to the number of periods, which happens to be 4 again. So this would be 1.08 raised to the 4th equals the future value. What is that factor? Look at the future value of a sum table, right, guys? On page A2, table A3, what do you get? 8%, 4 periods is how much? Table A, which one? Yeah, future value dollar. There it is. 8%, 4 periods. I'll find it. 1.36, everybody see that? 05. By the way, what if you put in your calculator 1.08 and raise it to the 4th? You get 1.3605. What grows to $1.36 over 4 periods at 8%? $1, right? $1 compound interest, 4 years grows to $1.36. So what would 882 times 1.3605? Because I'm investing 882. What would that be? Right around the $1,200 on it, a little bit of rounding. Okay, that's it, isn't it? So you see what's going on?
yeah, for future value, use the, like, formula for the value times multiplication, for when you're doing present value, use the.
1 over, yeah. Because when I'm discounting, I'm taking interest out, so I'm dividing, right, by 1 plus the interest rate. And then when I'm compounding, I'm adding 8% interest every year. Take it times 1 plus 8%. Okay? That help? Okay? She thinks mathematically, so this is fine. Okay, sorry. Everybody got it, though? So you could go either direction with these, couldn't you? Nothing to it. Okay, let's see. Let's try another one. 10, I guess. George's grandmother promises to give him $1,200 at the end of each year for the next 10 years. Yes, that's nice. I'd like that. $1,200 at the end of each year for the next 10 years. What's that? Those are future values, but each one's a future value. And it's the same amount each year for 10 years. So what do you think it is? Same amount every year. It's an annuity, isn't it? So that's an annuity payment. And for the end of the year, so it's an ordinary annuity payment. Good. Ordinary annuity payment, $1,200. And this is probably a good idea. It's $1,200 every time, but how many payments? You don't have to do this due to the calculation, but it might help you keep things straight. How much are we valuing? $12,000, right, guys? It's $12,000 total. It's a $1,200 payment, but it's $12,000 we're going to value. So what do we want to know? We know the ordinary annuity payment. Do we know the interest rate? Yeah, the interest is 12%. Do we know the number of periods? Well, yeah, there's 10 payments. It's 10 periods, right? So we're pretty good with that. And how much is the money worth today? What does that mean? I'd like to know it's what? It's present value. So I want the present value now. Everybody good with that? So what would I use? I've got an ordinary annuity payment, and I'd like to know the present value of it. How about a present value of an ordinary annuity factor? If I'm calculating the present value, use the present value factor. If I'm calculating a future value, use a future value factor. Sound good? That's easy to remember, isn't it? Okay, makes sense. Okay, so by the way, are these 10 payments going to be worth more or less than $10 right now if I'm taking the interest out? I'm talking about $10, right? Total, $1 each year, and I'm taking interest out of it, so what? It's worth less right now. Everybody agree? So my factor is going to be less than 10. That'll keep you on the right table. Go to the present value of an ordinary annuity table. So that's at the bottom of page A1, right? Appendix A. I wish they just numbered these pages. Anyway, page A1.
It's gonna go right.
Oh, I need 12%. We got to go to page A2, don't we? Yeah, there's 12. And then go down to 10 periods. What'd you get? What's worth $5.65? $1 received at the end of each period for 10 periods. $10 is worth $5.65. That makes sense? How much interest would you earn if you invest $5.65? I'm sorry, how much interest, I get, that's right. If you invest $5.65 and then they give you $1 at the end of each period for 10 periods, how much interest would you earn? You get $10 back on an investment of $5.65. It'd be $4.35, wouldn't it? Everybody see what I'm talking about? If I paid $5.65 for 10 payments of $1 each, I'd get $10 back for an investment of $5.65. How much would I earn? $4.35 interest. Well, 12% interest is pretty high, right? You almost doubled your money. Everybody good? Okay. All right. So what's 1,200 times 5.6502? Because I don't get $1 10 times, I get 1,200 10 times. 6,780. That's it. There's my present value. Okay? If you would be willing to invest $6,780 now and receive 10 payments of $1,200, one at the end of each year for 10 years, so you get $12,000 back, right? If you'd be willing to do that, that means you're willing to accept 12% return, because that's what you're earning. Okay? Are we good? You have to really think about this a lot to get it kind of intuitively and to understand what's going on in business, right? Okay. All right. Let's try another one. How much would George have to deposit in the bank today if he will be earning a 2% annual rate of return? Boy, savings account, I guess. And wants to have $5,000 in the bank at the end of 5 years. Okay, he's going to have to invest a lot because 2% is not a very good return, is it? But anyway, yeah. So he wants to have $5,000 at the end of 5 years. Tell me what these things are. Let's go for present value, future value, number of periods, and interest rate. Tell me which of these are what?
Interest is 3%.
Mm-hmm.
There is,
5 years?
future values, 5,000.
And what do we want to know? How much to invest now? What would that be? Present value. You can easily set this up, can't you? So what do? I take my future value now, right? I'm sorry, my future value at the end of 5 years. Come on, Keith. Future value at the end of 5 years is $5,000. And I want to calculate the present value now of that. That's what I'm going after. So set it up right like that. So what I'm going to take this times? 1 over 1 plus the interest rate. Right, guys? Raised to the number of periods. 1 over 1.02. It's only 2%. Raised to 5 periods. Or you can go look it up on the table. That's a present value of a sum table I'm going to go to. Right, guys? And it's going to be, each dollar is right now worth less than $1, of course, right? So I'm taking interest out. So if you went to the present value of a sum table, and you went to the 2% column, and you went down to 5 periods, what would you get? 0.9057, did I pick up the right one? You mean each one of those dollars I'm gonna receive in 5 years is only worth 90.57 cents right now? Yeah. What if you took 90.57 cents times 1.02 times 1.02 times 1.02, you did it 5 times, what would you get? $1. Right? That's why that's the present value of it. So what's 5,000 times 0.9057? 4,000 something. 5, 2, 9 maybe. How much interest would you earn? 5,000 less 4,529. It's awful, isn't it? $471. 2%. You know what the stock market earns? 6 to 8% per year plus inflation. So 12 on average, 13 over time. Really? Money I invested when I was 29 years old. I've been earning an average of 13% a year over all those years. How many times does your money double? Let's see. So I'm 63, you guys. My gosh. Maybe 64, please. So 64 less 29, how many years is that? 35 years? We don't have 35 on our table, do we? But a factor for 35 years? Somebody put in their calculator 1.13 raised to the 35th. What's that? Should have invested much more, much earlier. I was making money earlier, I just spent it. How much? 72 bucks. Every dollar became $72 that I invested. When do you guys want to start investing? And do you want to put money in a 2% savings account? They're not even 2, they're 0.5%, aren't they? You want to put something in a secure investment that earns 2% when inflation averages 2%? How much do you earn? If everything goes up by 2% and you earn 2%, how much do you earn? Nothing. And you know what the people do with the money if you've invested at 2%? They put it in the stock market or somewhere else where they can make money. You get 2, right? They pay you 2, and then they invest it at 13 or 15 or 20 or something, and they get to keep the difference. And they get rich and you stay poor. So guys, what do you want to do? Invest. God, I wish I'd have put in a lot more. I wouldn't be standing here. I'd be in the Bahamas. 6 foot underground because they'd have so much rum and food by now, right? But yeah, I'd still be in the Bahamas. Yeah, I spent it all on women. I was single back in those days. So, oh well. How much would George have to deposit in the bank at the end of each of the next 5 years if he wishes to have 15,000 at the end? Tell me what these things are. What's the 15,000? Future value, okay? When is it going to be? He wants it in 5 years? Okay. What's in? 5. Okay. And he wants to know how much he needs to deposit at the end of each year, so that's not going to be a present value. What's that going to be? Yeah, you got it. Ordinary annuity payment, that's what we're looking for, right? So we don't have to worry about present value on this one. Okay. Because it's not asking me for it. If I want to know the future value. If I wanted to know how much I need to invest to take that annuity payment out, they'd give me a present value, right? Yeah, that's the ordinary annuity payment, right? Present value. If I wanted to invest a lump sum right now to give me these annuity payments in the future, that would be a present value. But here we want to know how much we have at the end versus how much we have at the beginning. Does that do it? Okay, good. All right. So, and then we need an interest rate, don't we? What's that? 3%. Okay. So, what would we do that we're willing to take a 3% return? Where did I get these problems? These were not mine. I stole these. Okay, what do you want to do? I don't need the realistic interest. What do you want to do with this thing? I'd like to calculate this ordinary annuity payment. I think I just set it up. My ordinary annuity payment is going to be some amount, put it here, that will give me a future value, right, in 5 years of $15,000. some payment some payment that I'm gonna have 5 times, right? So that payment I'm gonna have 5 payments of. Some investment payments, okay? Some investment is going to grow to 15,000. Everybody agree? This is a future value factor for a what? Ordinary annuity, right? Okay. All right. What I'm going to do is if I want to know the future value, I'm always going to use a future value factor. Whether it's an annuity or a lump sum makes no difference. If I want to know the present value, I'm going to use a present value factor for both the annuity and the lump sum. Exactly the same idea. So because I know the future value and I'm trying to calculate this payment, I'm pretending like I'm taking a payment times the factor to get the future value.
When we did number 10,
Mm-hmm. Well, except that's how much it's worth now, which makes it a present value. You got it. Okay. There I knew the payments and I wanted to calculate a present value. If I knew the payments here and I wanted to calculate a future value, I'd do it exactly like this. If I knew this payment and I was trying to calculate this number over here, I'd still set it up like this with a future value. Does that help? Okay. Yeah. That's why I always like to set it up the same way, by the way. So the author divides, and sometimes they divide, and sometimes they multiply, and I think it can sort of lose you, right? Versus if you always put your payment over on this side, and either your present value or future value on the other side, you kind of get it made. If I am calculating a future value, I want a future value factor. If I'm calculating a present value, I want a present value factor. Okay? Good. So, what am I going to do, guys? What's my interest rate? 3%. What's my number of periods? 5. Where do I want to go? Ordinary annuity of a future value factor. Go to the ordinary annuity table, right? Future value of an ordinary annuity. That's table A4, is it? 3%, 5 periods, how much is it? Divide into 15,000, and what do you get? Okay, now by the way, are you surprised that number is more than 5? You're getting interest, right? Future value, you'd be adding interest. So it's $5, right? 5 payments of $1. $5 are going to become worth $5.31 because you're adding 31 cents interest to it. Remember, it's only 3% interest, so it's not much. Okay? So how much total payment how much total investment are we going to make? Or how much total payments are there going to be? I guess we are investments. We're investing for a future value. What's 2008, 25, 34 times 5, right? 10, 126? No, more than that. What was it? Okay. How much interest will we earn? It's only about $873 of interest, isn't it? Well, that's because the interest rate's so low, right? Everybody good? Was that the last one? Okay, that's it.
Is it just asking for the annuity payment?
It just wanted how much they were going to deposit each time, which is yes, the annuity payment. That's all it asked for. It did not ask for the total that was invested. Did not. I just think it's useful to look at that so it doesn't seem like it's magic. You can see what's happening here. If it asked how much we invested, it'd be $14,127. Yeah. I don't know. Who knows? Who cares, right? If you had the annuity payment, you had the number of periods, you could get there real easy, couldn't you? Just relax and work on you guys. You guys getting better at that too. I can tell. I can see your sword. Getting much better. Did you want to do something else? Is there something else driving me crazy you want to look at? We got a few more minutes. Or also you can watch the video, right? All we did is work this whole quiz.
We didn't work it, but that's because we did it in class.
Yeah, we didn't do number 8, but we did it in class. Right?
Fun stuff.
Mm-hmm.
We're doing the same thing pretty much.
Doing exactly the same thing. And theirs is just as easy as yours. These guys are sitting there while I went over here. Earlier. So. No, it's the same thing. It is. Well, that last problem we worked on too, that. Well, if you put enough calculations in it, thanks for taking the time to do this, you guys. It's really, really going to pay off for you. It's going to work. Did you sign up for Partners Day? You should.
I did, but they said they didn't get it.
Do what?
Didn't get their stuff together. I emailed them a long time ago, and then they lost it, and so you have to sign it. And yeah, way to handle that.
That wouldn't be good. Sign up for it. You enjoy it.
Just going to do.
You learn a lot. Make a good contact.
Are we gonna go to quizzes today, or what did you?